There we go. Good morning, everyone. We're going to let our attendees roll in here. Only going to be a handful of people today, so I think it's going to be a little bit shorter office hours than usual. Got our first couple here. Hope everything's going well. We're all spread out again. Daniel's in South Carolina, Paul Senior's in Minnesota, and I'm down in Texas, and Dave and Ryan are in Illinois. So we got the crew all over the country, and I think we have just about everyone in. So let's go ahead and get started. We didn't have any questions. I think the amount of attendees we get and our questions seem to be pretty related to how the market's doing and how worried people are in general. So today we got a little bit of a light show. So Pops, one of the things that you wanted to talk about is with interest rates being so low, anyone that has a material amount of bonds in their portfolio is kind of starting to feel a little uneasy about that. Not that bonds were a huge winner as far as return to begin with, but when interest rates are so low, I think people even kind of start to look for alternatives. What are your thoughts on that?
Yeah, it's kind of just been interesting. In the last few days, I've gotten a number of emails from people that, all smart people, that they're wondering. It all circles back to the same thing. They're all wondering, what, bonds earning 1% to 2%. Isn't there something better we should be doing or could be doing? And one client threw out, here's this exchange traded fund that owns nothing but utilities and it's paying a dividend yield of 3.5%. And I know this is on the minds of, and probably increasingly so. We talked about last show, I think, is the 60% stock allocation, 40% bond allocation. Is that day passed, and now you need to be higher stock market exposure because of bond interest rates so low? And it's been interesting. In my 36 years, I've probably seen more mistakes made by people reaching for interest rate or bond yield in low interest rate environments. Now this one is kind of epic of how low they are. I mean, you're looking at a 10-year treasury at 0.65% maybe, which means you invest $100,000 for 10 years, you get $650 a year. That in the backdrop of a Federal Reserve that's committed to inflation of target of 2% a year. So, things like 10-year treasuries, which we don't buy, you're basically getting some risk without the return. Our short-term high-quality bond funds, I'm just guessing right now, and I haven't looked for a while, probably are yielding somewhere between 1.5% and 2%. But they have virtually no exposure to upticking of interest rates, which is always a possibility when the Fed is, well, I'm going to say printing money, and the dollar is at support. And what that means is if the dollar starts to tumble, the Federal Reserve may have to rethink their strategy, and interest rates would theoretically tick up, and maybe somewhat sharply relative to current rates. So it's a really difficult environment. Excuse me. It's not COVID, I promise. It's a very difficult environment. And when you have 30 or 40 or 50% of your portfolio seemingly earning nothing, it kind of refocuses people, but I think it refocuses them in the wrong direction. I said in an email last night in response to a client, I said, look, bond returns, CD returns have always done nothing but tread water when it comes to maintaining wealth. They don't build wealth. They never have. It's just now that it's a little bit worse, but essentially we never look at the bond portfolio as a area of a portfolio that's going to drive a person's lifestyle. Lifestyle over a 2 to 3 decade retirement is going to be driven by the premium returns that have historically come from owning the great companies of America and the world. And let's not lose sight of that. And if bonds end up earning 0 or 1 or 2%, and if they're going to do that for a long time, it probably means inflation stays very low. And it means that equity returns are probably going to look even more favorable compared to inflation. So what I don't want people, and then I had a call yesterday, from a lady who's retired, and she's 70% stocks, 30% bonds. I think that's pretty aggressive for someone around 70. Not overly. It's for her case. It's probably, it's suitable. But wondering, hey, I haven't made a lot of money in the last year. Should we be doing something else? Is there something we could be doing? And again, I think this is a confluence of a recent bear market, a market that's flat for, say, the last 12 months, interest rates earning low, earning very little. I think investors and retirees start to extrapolate that over the next 10, 20, or 30 years as if that's a permanent condition. And at this rate, if I'm not earning anything and I'm spending money, I'm going to run out of money. And about all I can say is, look, nobody knows what's coming ahead of us. But when we're making decisions and telling people what to expect as far as their lifestyle, spending, types of money they might leave behind as a legacy, as an aside, it's based on much worse than what we experienced in the last couple of years. Is really just it's just kind of the package deal. Sometimes we'll go through extended periods of time when you'll really make you wonder. I mean, between 1966 and 1982, the Dow went from 1,000 to 1,000, and simple Treasury bills outperformed the stock market. And by, say, 1979 or so, that's when you saw people really give up on the stock market, just before the greatest bull market in history. So sorry for the long-winded nature, but I want to address that because I guess the answer is, should we be doing anything different? If there was something that could be done that was intelligent, that didn't expose us to more risk, the bonds portion of the portfolio is the side we don't want to have impacted by all the craziness out there. You start going into exchange traded fund, well, that's not a bond. That's a stock portfolio that pays 3.5% dividend, maybe. But at the end of the day, total return is the only money that matters, not what our yield is. So it's always refocusing on circle back to the plan. What does the plan require from an expected rate of return? Have we been sufficiently pessimistic about what the future holds? I think maybe too much so in our simulations. And therefore, anybody that's been with me a long time already knows what I'm going to say. It's just a difficult period where it's difficult to stay the course. And when we take our focus off of our plan, in the lifetime view, then we start seeing the obstacles in front of us, because, obstacles are those things you see when you aren't looking at your goals or your plans. So who knows what's going to happen? I suspect over the next 5 years, at some point we'll have higher inflation and higher interest rates, but bonds will always be nothing more than a treading water, which doesn't make them bad. Doesn't mean you don't want to own them. They're there for a reason. Simply because most people can't afford to have 100% of their investment portfolio if they're spending money in retirement in stock. So then if it can't be 100% stock, what's it going to be? Well, we want it to be in things that aren't impacted. That's CDs, bonds, et cetera, of short maturities. But let's not expect too much. Let's not expect more than they've ever done. And that is pretty much tread water net of taxes and inflation. The end.
I always remind people too, there's no free lunch when it comes to investing. So yeah, there are options you have for increasing the expected return of your portfolio. You could shift out of bonds into, stocks, or go into longer term or lower quality bonds. But in order to earn higher returns or higher yields, you inevitably have to take on more risk. And that may not be the right thing to do depending on your plan and your tolerance for risk. So I think sometimes people are looking for this silver bullet of, oh, well, what if I just do this, I shift into high dividend yielding stocks. It's like, well, yeah, you have a higher yield, but you also just shifted from something that's really stable, bonds, into something that's incredibly volatile, stocks. So it's a very apples and oranges thing, and you need to make sure, not saying you shouldn't do that, but there was probably a reason you weren't a higher equity allocation to begin with. So you have to kind of revisit that, and like you said, get back to the plan. well, why are we at the allocation we're at right now to begin with? And am I okay? Am I really willing to put up with the extra risks that would come along with increasing the expected return in my portfolio? That may or may not be the case.
Yeah, Dave, you never have anybody call and say, hey, can I take a lot more risk?
Right.
But they'll call, which is really what they're asking. They're saying, hey, should we take on a bunch more risk in order to kid ourselves and, after this elusive 3 or 4 or 5% dividend return? Again, this is just, I think it's really human for us to look at that. I'm reminded that, you guys don't remember this because you weren't alive, but when CD rates were 16%, and then when they were just kind of normally around 8 or 9, everybody thinks of those as though, oh, wow, we used to make a killing in CDs. Not really. When CDs paid 16 to 17%, you had to pay probably 4% of it in taxes, because taxes were real high back then, or much higher anyway, marginal tax rates. And then inflation was 13%. So even when CDs were paying 16%, by the end of the year, you've probably lost 3 or 4% of your purchasing power. So it's never the nominal rate, and this is just a difficult period where the best advice is just be patient. And you'll like 4% yields better, but they really don't. A 4% yield really won't offer you anything from a planning standpoint, a better deal.
The other thing I mentioned in an email to that same client was, anytime I've seen someone start to try to increase the yield of their portfolio or chase yield, you start getting somewhat goofy investment allocations. So you start having huge exposure to certain sectors or asset classes that tend to have higher dividend yields, or maybe you're really loaded up on, really low quality bonds. And then you have no exposure to other areas of the market that have, maybe it's stock, like an asset class that pays very little in dividends to nothing in dividends. So now we're just not owning any of that. And so when you start chasing yield, like I said, you just end up with a goofy investment portfolio that it's probably not going to really be that optimal on paper from like a risk return standpoint, just because of redundant, like overexposure to certain things and underexposure to others. And so, like I said, at the end of the day, the most important thing in investing is being diversified and not taking on risks that don't have any expected reward for taking them on. And I think that's what happens to a lot of people when they start chasing yield or chasing performance, is they start taking on risks they're not even aware of. They're not even necessarily thinking about how much they're exposing themselves to concentration risk, whether it's a specific company or a specific asset class or sector of the market. And I think it's really important to just not get caught in that trap.
And the other thing, Dave, I was thinking, and you guys can chime in, because it's really not just about you, like you said. So if you look at endowment funds that are multi-billion dollars, they have the most expensive, supposedly best consultants. And about 15 years ago, they decided that just standard investing isn't good enough for them. They needed higher expected returns, and so they ended up with goofy portfolios, like David said. So they searched out for alternative investments, private equity, all kinds of alternatives, I guess. And for some reason, nobody would tap them on the shoulder and say, why do we want an alternative to an asset class that historically is provided compounded at 10% a year? And I don't know if I sent it to you guys. If not, I will. Larry Swedroe, who's a really bright researcher, just talked about 2 major studies of all the biggest endowments in the country over the last, 15 or 20 years, I think. And it showed basically every one of them underperformed, kind of just the no-nonsense portfolio, that all these alternative investments have done nothing but detract from returns and not added to them. This is over and over again, and that's just the point of there's no free lunch. Having a stock bond mix is going to have plenty of disappointing periods throughout one's lifetime. But until somebody comes up with a better alternative, and they haven't, they all sound good. But when you look at their results, given enough time, it's always disappointing.
And I think this question just echoes back to the same question we always get, is reacting to what's currently happening as opposed to just keeping pace and staying on with your plan. Whether it's, normally we get the question about stock returns and can we increase our stock return portion of our portfolio, or maybe this particular sector is doing really, really well, or US is outperforming international. Why aren't we doing more in US? This is the first time in probably quite a while we've gotten the question about bonds. How can we get better bond returns? It all comes back to the same fundamental issue that as humans, I think we're so geared to try to seek out improvement, to not take anything that isn't optimized or somehow that we can put our finger on and try to say, look what I did, I touched it, I improved it. When in investing, that is like, Paul's great mantra is the more you handle it, just like soap, the less you have. That's the one thing I think that, we'll spend the whole career of as advisors advising our clients on. No matter what you think you have the opportunity to improve on, chances are it's going to detract from returns over the long period of time. And the best course of action is to stay on course with your plan and not try to eke out little changes here and there in response to market conditions. So.
Well, guys, I think we've pretty thoroughly covered this one. It is just kind of interesting how there's always something to worry about, right? Like a few months ago, it was the stock portion of your portfolio. And now, of course, we've switched to the other side of your portfolio. So there's always something, but I think that's kind of why we do these office hours. We want to make sure we're addressing those concerns kind of as they happen, or maybe even before they happen. So I don't see any more questions in our inbox, so I think we can go ahead and wrap up there. I will say one thing, Daniel definitely wins the award for best shirt of the office hours.
You like that?
What is that? Are those birds?
It's got some parrots on it. It's nice.
Well, now that you are moving to South Carolina, you have to wear that type of stuff.
I wore my Ruedi Wealth shirt yesterday golfing, and with my girlfriend's dad. He's really good, and taught me a thing or two, I'd say. But I was a little nervous to golf in front of him, so couldn't wear that shirt today. Needs a wash, but yeah.
I think this needs to be a traveling shirt, Daniel. Someone who has the wisest statement and the wisest advice on the office hours needs to get to wear the bird shirt for the following.
Well, I feel like if I dress like a retiree, then maybe I'll get some wisdom,
Sure.
I'll
start relate to them better.
And just putting them at ease, You're really, wearing the right outfit. Well, guys, I think that's all we got today. We'll see. Haven't made that decision just yet, but thanks again for being here, and we'll see you guys in a couple weeks to a month. Take care.
All right. Take care, guys.
See you later.